friends and associates. Welcome to Wealth Builders in Denver, Colorado. Scripture says in Deuteronomy 8:18, "Remember the Lord, your God, for it is He who gives you the ability to produce wealth." As men and women of God, we all want to succeed in our sphere of influence. We all want to make a difference in the kingdom of God. We all want to leave a lasting legacy for generations. Are you ready to be challenged? Do you thrive on inspiration? We all need a healthy dose of encouragement. You'll also receive expert instruction on proven and practical strategies and documented best practices. That's what Wealth Builders is all about. It's time to get off the sidelines and get in the game.
Hey, Billy and Becky Eppard here on Saturday morning, May the 23rd, and we're so glad you joined us today for this. We're now calling it Wealth Builders Live,
Yay.
And this is a webinar. And honey, we want to talk about for a minute why we weren't able to be here last week.
I did. I wanted to take a few minutes and thank our wonderful staff and our guest person last week, Bill Bronchek. My mother passed away, and so Bill and I had to drive to Texas. And so it was a 16-and-a-half-hour drive. And anyway, I thank everybody for jumping in. I also thank you. We've got a lot of comments and condolences and saying they're praying for us. And so we really felt it. So thank you so much.
And we want to thank Dave and Karen. They were the ones that did the awesome job hosting and putting together. And also Mike Davis and Dan Dyer, who did an awesome job. And of course, Bill Bronchek. So we're excited about doing this Wealth Builders Live. Now we know right now, May the 23rd, we're still kind of in the middle of this coronavirus thing, and we're dealing with it. And so, we're talking about the economics of it. But before we get in to really show you some charts and graphs and really let you look into what I think is happening today in the economy, both in the stock market, business, and in real estate. And of course, we're going to talk a lot about real estate and answer your questions here in just a minute. And Becky will tell you about that. But right now we have a couple of things we want to go over. Honey, you have them?
Amen.
And so just a couple of things we'll cover, and then we're going to jump right into the information.
First, I want to say happy Memorial Day.
Yeah.
If you've served in the armed forces in any way, capacity, and you're online, thank you.
Yes.
I think we appreciate it even more and more with what we're going through, the sacrifice that you made and those that are still in the military that are making for us, for our great country, America.
Amen.
So anyway, happy Memorial Day.
Yes.
I wanted to say that if you would like to keep up with more events, access to blogs and much more. And we just found out, I just had our staff tell us that we have 683 blogs cataloged and over 1,600 hours on the vlogs. So you can go to our website and access that. It's all free.
It's all free.
So I think that could keep you occupied for a while.
I mean, think about it. That's a lot of reading and a lot of watching.
It is. But you're home.
Yeah.
Praise God. Also, if you would like to subscribe on our Wealth Builders website, this week we're giving away Dan Dyer's Generational Wealth video teaching that he did at our conference, and it is amazing.
It's amazing.
You need to go on just for that.
Amen.
It will get you fired up. So anyway, all of that. And so if you'd like to go on and purchase, we're giving a lot of away little snippets of our 2020 conference. If you'd like to have the whole thing, which it was wonderful, you can go on and purchase that through our website. It includes all the audio, video, and the PowerPoints from each of the speakers.
Wow.
Yeah, that's a great thing to have in your library. That way you can go and access a bunch of information there. If you'd like to watch the previous week, we talked about that and thanked everybody. It was a great, I think they focused more on real estate. If you're just logged on and you're interested in that, they covered a lot of stuff last week on real estate. So you can go in and access that and rewatch it. Also, this is exciting. We have our real estate workshop coming up. It is fully Sold out. But you can still purchase. You can still be a part. You can purchase the live stream video for $3.99 if you go on and do that today. And you can click on the banner and it'll take you through all the things that you have to do. Also, I wanted to say, oh, looky here. We're giving away today your Money Mastery book.
Ooh.
You think you could sign that for whoever won?
I can sign it.
There you go.
If the office will help me do that.
One day it could be a famous thing.
No, that's awesome. Yeah.
Praise God. Anyway, and also congratulations to Andra Erickson, who won the free Living Your Purpose teaching last week. They'll mail that to you. Be looking for that in the mail. Also, if you'd like to be eligible for the gift we just talked about, your book, go onto the wealthbuilders.org site and you'll be able to be in the drawing.
Yeah, they register there, right?
Mm-hmm. Also, if you'd like to interact, we have our staff behind the scenes. You can go down and into the chat button and write your answers. Some of those will answer the questions at the end of this webinar. And also we'll do a Wednesday at 1.
Wednesday at 1 p.m.
Wednesday at 1 p.m. We'll answer some more questions.
Right.
So that'll be good. Also, if you'd like to give, you can go to the wealthbuilders.org/donate. Hit that button and it'll take you through however you want to donate. And we thank you so much for that.
All right. Well, thank you.
That's it.
All right.
I know you've missed a week, so you are on fire.
Now, listen, I'm going to tell you guys something that I probably shouldn't because it's real personal. But yesterday, Miss Becky got to go have her hair done for the first time in, I don't know, a while. But
I didn't wake up screaming and hollering this morning. So anyway, she's a happy man.
So she looks extra pretty today. So we appreciate we appreciate the hair stylist making herself available. So thank you. So what I want to do is jump right into the economic information, and we're going to look at some of the charts again, some of them that we've been looking at. So the first chart would be from March the 20th. Remember, the market actually bottomed on March the 23rd. So you see how far it came down when this virus hit. And for those of you, I know some of you are really new to this kind of stuff I'm talking about, but you see those two lines on this graph. The black line and the red line. The red line is the 50-day moving average, and the black line is what we call the 200-day moving average. And that just means if you look at where the market was averaged out every 200 days or every 50 days, that's what these lines represent. So we'll go to the next graph, March the 27th. We're only going to show you 3 of these. And then you see that low right there. That was March the 23rd. Then you see how the market popped back up, all the way back up on March the 27th. You can see that. And then we're going to jump all the way to May, from March the 27th, May the 23rd, to basically 2 months later. And you can see the same, these are the same graphs, and you can see how the market has been hovering right there. It went back above the 50-day moving average, but you can see how it's hitting resistance right there at the black line. It continues to hit resistance. What I think is going to happen is that now, I don't have a crystal ball, but what I believe is going to happen is that the market is going to go back down, and actually we would form a W shape. So, and I'll show you some other graphs in a second that will tell you why I believe that's true. But right now, I'm just showing you that we have the left side of the W, in my opinion, that's been formed. Now, some people are saying, still continuing to say, since the market in these 2 months has kind of traded sideways, is kind of what it's done. What people are saying, it's going to be more of a U, which it could be a U. But with the economic data we have coming in, I'm going to tell you what to do about it, and don't freak out and do something crazy. I'll tell you in a second what to do about it and give you some graphs. But I just want to show you this, and then I want to show you why I think the market actually has come up like it did. I mentioned this 2 weeks ago, but I think it's real important right now to tell you this. If you look at the next graph, this is on the Fed stimulus. And you can actually see how the market, the blue line there, of course, is the stock market, how it popped back up. But you can see in the red line, you can actually see how the Federal Reserve, we call it the Fed is increasing their balance sheet. It just simply means right now that the Fed is buying bonds, and in some cases even corporate bonds, and they're also they're beginning to even invest in certain ETFs and some equities. And so the reason we're showing you that is all of that Fed money, trillions of dollars coming in my opinion, it's been propping up the stock market. Now, people go, well, how come that's happening? Well, one of the reasons is there's not a lot of choices right now, not a lot of different ways in order to handle this particular crisis. It's been unprecedented. There's no way to really determine which way this thing, meaning the virus, which way the virus thing was going to go. And so what's happening is right now, the Fed's doing what they think they should be doing, but just like anything, there's kind of a yin and a yang. Mm-hmm. There's a positive and a negative. So the positive side is the people that are unemployed, which we're going to show you in a second, and have gotten stimulus checks. That's been a blessing and it's helping people. But then the flip side of it is these trillions of dollars that are coming into the economy all at once. We've never had this level of flood of money from the Fed coming into the economy. So there's some things that are kind of here that are kind of unknown. And I'm going to tell you what I think that means in a second. I'm trying to describe it to you, and then I'll tell you what it means, okay? So now let's look at the next graph for a second. And this is just another graph. The next PowerPoint slide, Derek, if we could go there. There it is. You can see where I was talking about it being stuck. So you see the 50-day moving average is red. And, of course, on this one, the 200-day is green. And you can see that yellow there that's been marked, that the S&P has been stuck above its 50-day and below its 200-day for about a month here. And really, it's been a little longer than a month. So when you look at this, so people ask me, well, Billy, what's going to happen? So I'm going to give you a couple things that they were in the video slides before, but I didn't have a chance to talk about them. So I want to show you where I think we're going to head. And so this next chart here is kind of a funny chart. It's got some smiley faces and some sad faces on it. But this is when, for example, people get euphoric about the stock market. You can see the smiley face and the green euphoric there. And then what happens is that it starts coming down. And the reason that I'm showing you that is that that's where I think that the right half of the W is going to happen. And what's going to happen, there's anxiety, denial, fear, depression, panic. And then the big word, the key word is capitulation. That's when everybody starts selling, coming out of the market. Everybody's despondent, and where I have, there's a box there that says the highest potential for earning. That'll be the bottom of that right side of that W. It will be right in there is where I believe we're going. Right now, we're a long way from capitulation, just so we're clear. What that means is everybody's selling. Big money, little money, everybody's selling in the market itself. But of course, when you see, as Warren Buffett has said many times, that he buys when he sees blood in the street. So that's a metaphor, not meant literally. But the point is when he sees things that are happening that are really bad. So people say, okay, what should I do here? Well, I didn't have a chance to cover this next one, but I want to just show you this very next chart. If you already have a 401k or an IRA and you're in the market right now, you've already got money in there, then just, if you can, just be patient. And the majority of you can be patient, because if you stay fully invested in the market, for example, if you would have put $10,000 in, if you stayed fully invested and not taking it out in the ups or downs, you'd have had a 9% annualized total return. And your $10,000 would have brought you to $36,418. And you can see here, assuming you could have put $10,000 in the S&P index at the end of 2004 and stay fully invested through December 2019, you would have earned $18,060 more than someone who just missed the market's 10 best days. That's the problem of buying and selling, coming in and out. So if you miss the market's 10 best days, your return would have been $18,000 less. It would have been half because you got in and out. If you miss the best 20 days, right, then it would have been 11,000. Missed the best 30 days, 8,150. You missed the best 40 days, you would have lost money. So if you missed the best 30 days or the best 40 days, you'd have actually lost money. So if you missed the best 10 days, you'd only made 4.1% on your money, not 9%. So the reason I'm telling you that is that, and we'll talk later at some point in another program about drawdowns. And so what is a standard? I know Chad Franson, that works with Wealth Builder Investment Services. He's an investment advisor. You know, he and I have talked about this on what we call drawdowns, and the classic conservative drawdown in the stock market that people will tell people that what we mean by drawdowns is how much can you withdraw every year from your assets and not really lose the principal of your assets or your earnings. And the conservative number is 4%. Some people will go as high as 6%. That means if you have $1 million, you could take $40,000 a year out of there and not have to worry about losing your principal. Just typically there's no guarantee to that, but that would be the case. And I like to say in real estate, if you invest in real estate and you practice some of the stuff we teach and follow those things, you can literally easily, in my opinion, you can easily take 10% out annualized on your total investment in real estate based on your income. So meaning based on the cash flow coming out of your real estate, if you do it right, do it like we teach you. So it's a little better, in my opinion, than the market. But the point is, I'm trying to tell you, don't freak out. And I'm showing you this is just stay steady. I do believe it's going to go down. And I'm going to show you why, again, I think it's going to go down. So if we go to the next chart that we have, I want to show you this unemployment again. And I just want to point it out. That red line there that's going straight down is our 2020 employment recession. And it's actually above. This shows it being 14%. It's actually at 17.8%. But look at the employment in the recession of 2007, the blue line. You can see it never even reached 7%. And currently we're at 7. Now this one shows 14%. And look how fast it fell. There was no curve here. It just went straight down. And that's because, of course, of the virus. Then if we look at the next one, we have some more unemployment numbers just to show you. This is a new chart. It's showing 17.6%. I have another chart that shows 17.8. So I don't know the difference between the 0.2%, but this one is showing 17.6%. If you look back at the other recessions, the highest unemployment, you can see here, they're showing the Great Recession at 4.3%. So the point is, if you're looking at these, we are dealing in unprecedented times. And right now, the stimulus is not allowing unemployment to affect us. But when the spigot starts turning back on, and I'm going to be on here Saturday mornings at 10 o'clock, and I'll tell you where I missed it or where we didn't or whatever we need to tell you. We'll be honest about it. But right now, this unknown, this huge unknown, literally is this whole unemployment thing. And so if we go to the next one, just to the next, I'll show it to you. So just in the last 7 weeks, I showed this 2 weeks ago, it's 33.5 million people that were claiming unemployment. And just so you have a frame of reference, we've never, ever had this kind of unemployment, even in the Great Depression. In fact, Karen, you were telling me about suicides. You were saying, was it?
Yeah, I was listening to a doctor from Orange County expressing concerns about things not opening up. And one of the effects he's seen is that suicides are higher than they have been since the Great Depression. And so it's really starting to affect, the mental health of people, along with a lot of domestic abuse, unfortunately, calls that are keeping a lot of the law enforcement people very busy.
So I think the key, in looking at that is a lot of that is people are at home, honey. They're unemployed, right? And just so we're clear, there are people out there that are receiving stimulus money. We thank God for that. Many of you have, and meaning that you're able to get some, but there are many who haven't. And there are many that are really hurting financially. We need to be praying for them and standing with them and helping them. I know yesterday you gave a pretty significant tip to your hairdresser.
I did.
Yeah, and just because you hadn't been able to see her. So I think that's a big deal. Now, the next two are going to be on real estate. And so just quickly looking at it, and I got through these a little quicker today, you can see this is existing home sales as of April 2020. And you can see, of course, 2005, 2006 were the peak that we hit right before the Great Recession. You can see then the home sales around 2010, that how far they fell. And then we can go all the way over now to where we are today. You see that line coming straight down. Existing home sales have gone down. Now let's go to the next graph, and it'll show you this even more poignantly. You can see this is the green box is the Great Recession, home sales coming down. And then you can see to the right here, the same thing similar that we're in as of April 2020. And so we see home sales that are actually dropping. Now, I know what many people believe, and really nobody knows yet. We're in a low interest rate environment, and always when you have money, I call it cheap money. When you have money that cheap, typically it pushes asset prices, or in this case, real estate prices up and sales up. Of course, the coronavirus has hindered that, and some markets in the country are actually doing better than other markets. But from being an investor standpoint, what I've said on here going back 6 weeks ago at least, where I said that, look into the fall and just to kind of see where real estate prices are going to be. I said mid to late fall, and look, and you may be able to find some bargains. If you're real estate investors, you start watching for it. And by the way, in different markets, make sure you're keeping up with the market you're in or the one you're investing in, because remember, all real estate is local. Now, economic conditions affect local real estate sometimes differently. Mm-hmm. So make sure you have a pulse on the areas of where you're wanting to invest. And let me encourage you on the other side. On the other side, don't force it. Don't say, well, it's different times. And what I mean by forcing is don't get outside of your formulas, your investment formulas. Don't get outside of the things we teach. And so we've been talking about different markets in that area. And so today I'm intentionally going to stop a little bit earlier, honey, than
for questions.
Yeah, for questions, and make sure that we have a chance to answer some questions. And I'm watching my watch and the countdown thing here. And so if you have questions on real estate or the stock market or the economy, you can go into chat and do it and send them. So I think Karen is going to start with a few that we've had, I think, that I wanted to address. So Karen, take it away.
Thank you so much. This is great information, Billy and Becky. Thank you for taking the time with those slides. So this question came in from Alicia, and it's really a good question. She says, would it be smarter for us to take the money we would have used for a down payment on our personal house and use that to buy several investment properties? Last week, Bill was talking about the rates being so low. It is a great time to get in the game. Just not sure what makes more sense. We could rent for a year and wait for a deal on our personal home. Just not sure about the interest rates on a $700,000 to $800,000 home compared to buying a few investments at a lower interest rate. What's your direction on that?
Well, I think that's a great question, Alicia. And what I would encourage you to do, if you look at what I call the 30,000 foot view, compare the interest rates right now to what they've been historically, And even on a $700,000 or $800,000 home, the question that I have for you, first of all, is how much of a down payment are you actually looking at putting on that home? Because if you're going to put, I like to see people, just generally speaking, and everybody's situation is a little bit different, but just generally to everybody, it's good, honey, for you to buy your own home where you're going and not rent. Now, I know I'll get some comments and people saying stuff, well, you know, what if homes are overpriced and all those? So you've got to use some common sense. You don't want to just jump in, but all things being equal, it's better to buy your home, put money down, and then this is the same thing I told Mike Davis, who's on with us today. And Mike, what did I tell you when you had equity in your home?
You said I could take the equity out of that and then go and purchase my investment property, and that's exactly what I did.
Right. And so what I would say to Alicia is if you're going to put enough money down where you could come back maybe a year from now and be able to go and get either a home, what we call a HELOC, a home equity line of credit, or you literally could refinance and pull cash out depending on your circumstance. Most of the time, and I wanted Karen to ask this question, Alicia, because a lot of people need to hear it. Mike started building his real estate portfolio by getting, in this case, I can't remember, Mike, if you got a new first mortgage or a HELOC on your home. What did you do on yours? I don't remember.
I refinanced, yes.
Yeah. So you refinanced and got a new first mortgage because you had yours paid down, and you took that money and started investing. And
right.
At least many years ago when I first started, I started with a home equity loan. And what I did was I refinanced, pulled the cash out because homes had gone up, and I started investing with that money. I remember very distinctly because that was a big move for us at that time. So I think
So is she moving? Or
Yeah.
is she staying here?
No,
I
she's
didn't
saying-
understand the question.
Yeah, she's saying she's moving. She's leaving. I think if it's Alicia, I think it is. She's leaving Denver, and they're going over toward the East Coast. And I wanted to entertain this question
Well, I know
because
some of the people we've talked with also in different areas of the country, it's actually cheaper to build.
yeah, and it
So
might
you
be.
got to really check out the market. I mean,
Yeah, honey, that's a good point because it is. Sometimes in areas you actually can build cheaper a lot. You see it in the Bible Belt a lot where you actually can build per square foot as cheaply with brand new materials as you can.
and that would
buy.
give you a lot more equity than you could buy more houses.
It'll cross over. Here in Colorado, Woodland Park was that way for several years. You could actually build a home cheaper than you can buy a home. Now it's kind of caught up, and the contractors have gotten wise to the game. So I think what happens, and materials cost more as well. So, in fairness to the contractor. So I think what I would consider doing is buying your own home if you're putting that equity down on it. And then in a little while, even in 6 months, if you needed to, you could get some kind of home equity line of credit. Now, if you don't have that, which I'm assuming you do have money to put down because you said you were going to take that money. I'm assuming the money you made off the house, your equity, and you were going to buy rental properties. I'd buy my home first, and then I would use a home equity line of credit to be able to invest. That's bottom line.
Great. Thank you so much. This question is from John Blodgett, and he says, hey, Billy, we have a 1.75 acre property in Orlando, Florida that has become very popular with land buyers and builders, but of course, none want to pay what it's worth. But I had a builder send me a letter stating that they would like to build on the property and give us a lot subordination. I've never heard of this before. Do you think this is something worthwhile to take a look at?
Well, what I would say to you, John, on this is that subordinating land it means that the builder would take the 1.75 acres and would plat it into lots. And then the bank would loan that builder the money to build that house. But then you have to, as the owner of the land, do what is called subordinate each lot to each house, so to speak. So basically what you're doing is you're putting the money down for that builder to be able to build that house. Your land becomes the down payment, as it were. And so what most of the time, if you haven't had experience in this level, in this area, subordinating land is not smart. We actually built a 40 back in the day. We had a 40 lot setup, prime property, and it was 10 acres, prime, well located, right in the middle of the city. And a builder from Canada came in, and we negotiated with him. I will tell you this, we got our money back out of the land, but if you're not sophisticated and understanding the way builders can do things, I'm not saying they're not honest, depends on which builder you're dealing with, but in most cases, it's much cleaner and much smarter and much safer to sell the land outright. Mm-hmm. And don't listen to people that tell you you're going to make a lot more money if you subordinate. The minute you subordinate, unless you got a good attorney and really good contracts to help you with that, you're going to be the last one that gets paid in the standard contracts.
Right?
Oh, yeah. And they can
you're left holding the bag.
There's about 10 things that can go wrong. They can start building and not finish the house itself. And if you don't know their financial situation, they could run out of money with the bank. There's other things that can happen where if you're not really savvy on your contracts, they can actually put builder's fees on the top end of the cost of the house. It's just embedded in there. So in essence, if you're not careful, they're getting paid twice. In other words, they get paid when it sells, but they get paid while they're doing it. And so if you say, well, what's the point there? The point there is they're going to get paid. You need to get paid. So you say, what do you mean? Well, then you could get paid interest on the land that you're subordinating, for example. So they're getting paid twice. You can get paid twice. So there's other ways to do it. But my advice, if you've never done this before and you've never heard of subordination, I would not do that now. Now, I know I'll get some comments back. But I'm trying to, and people in builders or whoever going, well, I'm not saying all builders are dishonest. That's not what I'm saying. I'm saying if you on your side do not understand subordination and how those things work and already have a good lawyer to help you walk through that, I would stay out of that. I would hold my ground, just stay with it and let somebody come to you and make an offer.
Very good. Thank you. This question is from Williams Bob, and he says that he has an opportunity in Woodland Park to purchase a new build townhome. The current appraisal has a townhomes at $325,000, and he's able to purchase it for $300,000. However, with the purchase, the payment would be approximately 47% of his gross income. He's a veteran and can purchase with no money down, and he's conflicted. Should I proceed?
Well, typically, was it William? Was that?
Yes, Williams Bob.
William Bob. William, what I would look at, always remember is that you really don't want your total indebtedness to be above about 36%. And so in some cases, if you have good income and consistent, where you're getting paid, et cetera, you could go as high as 40. And that's total debt. That's if you have a car payment, a house payment, whatever. I don't think I would put myself in a 47% situation unless you have some other way to increase your income or you have some other way to address the shortage of what you would need. Or you're going to find yourself, the good news about, now the flip side of that is with the VA, people who are participating this morning may not know that with the VA, you can get a no down as a veteran, which I think is awesome. And so you can do a little better in that context in order to be able to get into a home. And so without having to have a big down payment. And so I think in that sense, it may serve you well. Woodland Park is a great market, and it's really it's a hot market right now. But William, I would really pray about that and be very, very, very careful about trying to get into a 47%, what we call loan to value, or in your case, actually debt that you would have on your payment against your income. That's a really high debt ratio.
It really is.
Great. Thank you so much. This is coming in from Heather and David Armstrong, who you both know very well.
Hey, guys. Hey, Heather and David.
And they say we have an opportunity to purchase a fourplex listed at $480,000. Is it better to wait or buy now while the rates are low?
Well, again, I know Heather and David, we know them. And so, guys, the key to this, again, as you've heard in the real estate workshops, it's not so much are you getting the best deal, the absolute best deal now, or would you get the best deal later? The real issue is the cash flow and the income on that fourplex. Are you cash flowing? And so always remember, on a fourplex, Billy likes to see $200 a door. So that means that you know, if you're making a really good buy, that 200, so that means after your principal, interest, taxes, and insurance, and in some cases management, depending on the situation, but principal, interest, taxes, and insurance, I would like to see $200 a door. And people ask me about that kind of stuff, but remember, now I'm going to say something I haven't said before on here ever, meaning on Wealth Builders Live or on the new normal we were doing. And that is, remember that the big money in real estate is made long-term out of your real estate appreciating. But you should be putting money in your pocket from the cash flow. Mm-hmm. So what happens is, and I'm saying this for everybody, not just Heather and David, that what happens is you have vacancy and repairs that go with real estate, which can decrease your income. Mm-hmm. And the reason we say you want positive cash flow of $200 a door is because it covers vacancy and repairs. And if you're managing it right, it'll cover vacancy and repairs and put money in your pocket. So you'll have actual income every week, every month off of your property. And so that's where you want to go. So more important than did I get the best buy up or down right now, what's really important, honey, is that they cash flow at a level that makes the kind of sense we're talking about.
That's great. Thank you. This question is from Matthew Lafferty, and he says, in Billy's Real Estate Mastery Manual, he stresses having a partner contingency clause in contracts. What period of contract does this apply to, or what part of the contract, I think is what he's asking. And then as far as period, like at what point, like how far can you have that contingency out? Can you have it out up to 30 days?
Well, yes, because in a real estate contract, you can put whatever terms in there you want to put. Doesn't mean that the seller or the buyer, depending on which side of the contract you're on, is going to agree to those terms. But what I was talking about there, and I was saying it kind of tongue in cheek in the manual, was when Becky and when I was out really buying property all over the country, I would put in most contracts, not in every contract, I would put, I'm going to write, and I would write the terms of the contract, the price, when we would close. And of course, in most of our contracts, we paid cash, so there wasn't a financing contingency. But the point is then I would put all of this is subject to the approval of my partner, which my partner was Miss Becky sitting here. And so I just used that as a way to get out of the contract if I found something that was really strange or whatever. So it's not being dishonest, because they don't have to accept that. They can say, no, we're not going to wait for the approval of your partner, and so we're not going to accept the contract. So it's not being dishonest, but that's what I meant. I meant always use that during that initial offer period, and always remember that seller can come back and say, you have 24 hours to get the approval of your partner, or 48 or whatever it is. And then when I write that kind of contract, I usually will give the seller 24 hours to respond. I don't give them 72 or 48 unless it's really unusual circumstances that are around it. So you write the contract, you put in there, I'm offering you $100,000 for this house. It's contingent on the approval of my partner, but I'd like your response back in 24 hours. And then sometimes they'll come back and say, well, we want your partner to sign off on this before we accept it. If your partner signs off, we'll accept it. So it just depends.
It comes to negotiating.
Yeah, it's one way to negotiate. And Karen, you and Mike jump in here. I'm kind of on a roll here today. I'm in a different setting this morning than I'm normally in.
You missed last week.
Yeah, it feels different.
Also, Dan Dyer's on too. I don't know if you saw him
Dan
or
is
not.
on. I didn't know. Where is Dan? I don't see him.
Hello.
Hey, I didn't know you were on, Dan.
He was out doing his barbecue.
Hey, man, you don't.
I've been on the whole time.
You've been here the whole time? I didn't know you were here.
The whole time. I've been loving it.
Hey, listen, we're offering your generation.
No, it's been great.
Man, and you look good. I can tell you lost some more
I
weight.
saw that.
Man.
I'm on the tapeworm diet.
You're on the tapeworm diet.
Yeah.
I like that. Hey, can you send that one to me? I need it.
That's awesome. All right. This is a question coming in from Linda Mattoon. And Linda says, what is your opinion about investing in real estate in opportunity zones? She is from Everett, Washington.
Well, I think, I don't know if anybody else wants to take that, but Dan, are you familiar with opportunity zones?
The term, no, but where I live is an opportunity zone. I mean, if you, I look within a 50-mile radius of appreciation and what's coming into the area, the market, and that's where I invest. Opportunity zone. Do you have a definition for that? Well, as far as what they're asking?
Yeah. So opportunity zones are zones that typically the government has defined, where if you make certain kind of investments in those zones, a lot of commercial, more commercial level real estate. There is some single family opportunity. There's multifamily opportunity, and there's some commercial opportunity. And so you get advantage with tax credits. You get advantage with financing, and so the answer to all those kind of things, and I think it was Linda who asked that question, is just make sure you understand, first of all, what makes sense from a real estate perspective or from an investment perspective of the real estate. And then I'm getting ready to say something I hadn't said on here as well. And then you look at your own personal situation, your tax situation, your income situation, or if you're putting together a partner deal, and see if it makes sense for you. Because what I see happen a lot of times is people go, man, I can't miss this opportunity, not to play on words here, but I can't miss this opportunity in this opportunity zone. Wow, what a great deal. But it doesn't really fit where you are personally in your finances or what works for you. And I used to say this in real estate investing a lot. And believe me, I got burned quite a few times, so I learned it. And here's what I learned, that there are times when you have to say no to good things, even in investing, because it doesn't fit where you are at the moment. Either it doesn't fit in your finances, maybe it doesn't fit in your time frames of where you are and how things are rolling. I used to say to people all the time that I like to use real estate agents, and I used to say that, and they would go, well, what if an agent finds a really good deal and they buy it out from under you? I say, praise the Lord, because here's what happens. Nobody has unlimited money, and if you're looking in good areas, there's always going to be more deals that pop up, and they can't buy every good deal that pops up.
Well, I think on those opportunity areas, aren't there sometimes where they take it into like it's on the edge and they want to revamp the whole
area,
community area? Right. What I would say is that it's a good worthy cause, but if you're not there yet, I know one of the reasons we got into real estate is to build our portfolio so that, like you said, I could be the one that brought the opportunity. We would go in and buy 3 or 4 houses in a street, both sides, and redo all of them and up the value of that. So we became the opportunity zone.
Right.
So sometimes if you're patient, I know your heart is there, but sometimes there's a different way that you can be led to do those things.
So what I would say specifically to Linda, if the opportunity in the opportunity zone, both from the tax standpoint, the financing standpoint, and what the deal is, fits where you are personally or helps you, I would definitely look at that, and I would definitely entertain it, because there are some opportunities in the opportunity zone. Just got to fit where you are.
Oh, that's great. Thank you. Just to let you know, Billy and Becky, we have a lot of questions coming in, so thank you for leaving a lot of time for that today. This is from Paul Bruzinski. He says he's new to this live cast. Welcome, Paul. And he's new to investing. What percentage do you recommend for down payment on a rental property?
Well, I think that's a great question. And Dan, I don't know if you or Mike or Karen, if you guys want to jump in on that, please go ahead and do it.
Go ahead, Mike.
I know that all banks aren't created equal, because there's a lot of times bankers will say, well, you have to put 30% down on investment property. Well, just go to the next one, because you can get 20% usually all day long at your mom and pop banks. And so I would really check out banks. I had to go to every mom and pop bank in Pueblo and ended up going to Fort Collins Longmont to get the loan that I wanted. So don't be afraid to go to other banks.
Yeah, shop.
Dan?
Yeah, I love that. Something Billy's always taught us is all banks are not created equal. And so Mike Davis might have had to go to 10 banks to get the deal. And so, shop for your bank like you shop for your house, right? If you find a house that you want, you should spend that amount of time as well finding the financing that you want as well. So
Good. So go ahead, Karen.
No, I was just going to say too that we might want to just touch on ways if people have got equity in their primary dwelling, and what might be an option for them to be able to take that equity out to use for investment properties. So one of the vehicles that we talk about is home equity lines of credit. And then we don't have to refinance the entire primary dwelling, but that is a great way to access that down payment.
Yeah, so excellent. And so let me just say this, and what was the name of the person that asked the question?
Paul Ruzinski.
Paul. So Paul, typically in buying investment property, if you're in that first 1 to 4 investment properties, there's what I call a lot easier mortgage money available in the 1 to 4 investment property range. Typically. And so sometimes you can actually buy, if you have really good credit and really good income, sometimes you can buy an investment property for as low as 5% down. And so you can do that. Now, what some people do, Paul, is they buy an owner occupant, live in it for a year or two, and then they keep the mortgage they had on it because they were able to get into the owner occupant means you're going to live in it. And then they move from there and they buy the next property house, say, a year or 2 years later, and they're able then to put less money down. Typically, if you put less than 20% down on investment property, you're going to have to carry mortgage insurance. Mm-hmm. And so you have to know that the payment's going to be slightly a little higher. So the typical traditional approach when you're using mortgage money is about 20% down. When you're maybe a larger investor and you're really running and gunning, most of the time you'll have to put 25% down. But always remember this, and this is something that needs to be brought up here, that if a person knows what they're doing, and let's take a $100,000 house and they buy, let's say it's a $100,000 house, and they're able to buy that house for $85,000 because it needs repair and rehab. So let's say they pay $85,000 for a $100,000 house. They rehab it and they do a really good job. They spend $15,000 and now the house is worth $120,000, right? So you bought it for $85,000, you spend $15,000, so you got a total of $100,000 in it. Many times the bank will loan you easily 80% of that of that new appraised value. And that means the bank would loan you, if I'm doing my math right here, the bank would loan you $96,000 on that property as repaired. If that's the case, then you only had to put $4,000 down on in this case, on a $100,000 loan, and that's a 4% down payment. So you just have to understand. That's why when these guys, Mike and Dan, are talking about shopping for banks, because a bank, especially those that are doing portfolio lending, what we mean, they hold that loan inside the bank and they don't sell it out to Fannie or Freddie or Sally or VA or whoever. When they do that, then what happens is you can get by. And I used to buy property all the time, commercial. I did more commercial loans, but I would buy it for zero down because I would buy the property cheap, rehab it, and the new appraised value on it, there was plenty of room to get an 80% loan to value on that house, which ended up being 100% for me. I was able to get into it for that amount of money. So if you don't understand what I just said, Paul, about the loan to values and stuff, you can get the manual or some of the other things that we have that'll help you understand how that works.
Very good. Also, I just wanted to mention that banks right now are really looking for solid places to lend money because their money is so cheap. It's like at 0%. So this is a very, very good time to go out and start establishing relationships with your local bank because they're looking to put some money out there so that they can earn on that margin.
Absolutely. Good. Very good.
And you may also tell him, since he's a newbie, about the live stream for the real estate conference. I know it's booked up, but this may be a good time for him to know about that.
That's great, Mike. Thank you.
Thank you, Mike.
Just to remind everybody, if you go to wealthbuilders.org, we do a real estate workshop, real estate mastery workshop, and we do it twice a year, and it's in Denver, June 12th to the 14th, and we have sold out for in-person, but we are doing a live stream where you can join us from anywhere, and you'll have access to the entire conference. So Billy, Becky, of course, I'm there, Dan, Mike, Bill Bronchek, who you heard last week. It is a phenomenal conference, and we're so excited to bring that to you via live stream, and it's just $399. Also, you'll have access to that conference for a week after the event. So if you're not able to be online the entire weekend, no worries. You'll be able to watch it throughout the next week. Thank you, Mike.
That's a good deal.
All right. This is a question from Lydia Chan. Billy, she says, Billy mentioned $200 per door. What does that mean? She says, I'm sorry, I'm a newbie to this group. And she's assuming it's a reference point from the United States, but she just really wants to know more about that.
Well,
Go ahead.
what are you going to say?
No.
So basically what I mean by that is that if you had a fourplex, which is what we're talking about, is $200 per door means you would have $200 of positive cash flow after your principal, interest, taxes, and insurance, or the way to say it, after your whole payment, you would have. So that means on a fourplex, when you were making your principal and interest payment and then your taxes and insurance payment on that property, you would have a total 4 times 200 is $800. So you would have an $800 per month positive cash flow over and above your payment. That's what I like to see. Now, some people buy them with $100, some with $150, but if I can really get the margin I want on that property, I want to get $200 per door. That means $800 a month in positive cash flow.
That's great. And we cover that in detail at the Real Estate Mastery Workshop as well. So that would be very helpful. This is from Butch Hartman, and you know Butch Hartman.
Hey.
Butch and Julianne.
He says, what do you think about paying cash for all investment properties? And this is based on purchasing them for under $200,000.
Well, I like that because right now I pay cash. So let's talk about that for a second. What happens when you pay cash, Butch, is that the return that you get on your money. So let's say, what do you say they were all under 200?
200.
So just for easy math, let me just keep a property at 200 for a second. So for easy math, so let's say I paid $200,000 for that property, and I'm paying cash, right?
Mm-hmm.
So one of the advantages that you have in paying cash is you don't have the principal and interest, but of course you have the taxes and insurance. So the real secret sauce to that is you need to be getting enough cash flow and or appreciation if you're paying cash, because now your cash flow is not about vacancy, but it is about vacancy, but not direct. You still have vacancy and repairs, but the point I want you to see is if I can make on my money what we call a 10% cap rate, which basically is that 1% a month or 0.8% a month, if you can get that on the rent of what your total investment was, if you can do that, so somebody says, what does that mean? That means if you paid $200,000 cash, can you get somewhere in the $1,500 to $2,000 a month? I prefer to be at the $2,000 a month or the $2,500 a month for that house. If I can get that kind of return, here's what you get to see is that the net on that is you'd be making about 10 to 12% on your money if all things are considered the same. Now, for those of you that are trying to add this up in your head, let me just tell you about one thing here, Butch, on this. If you buy, let's say, as many as 10 of those, then probably with the IRS, you can get what is called a professional real estate designation as an investor. So you become a professional real estate person, and those returns I just listed of 10 to 12% are then easy to get because you get to carry all that depreciation over. You're not limited in how much your write-offs are. So in some cases, you can get up with that designation because of tax write-offs. You could get up to 20% a year in annualized returns when you get to that level. Now, one more thing, Karen, let me say this. The advantage of not paying cash is that then your cash on cash return goes way up when you put, let's say, a 20% down payment and borrow the 80%, then my cash on cash return can get as high per year as 100% annualized. And people say to me, well, how can that be? That's impossible. Hold on. Because if I buy a $200,000 house, I get a 6% appreciation. That's $12,000. Okay. Now I'm not saying you will. I'm saying if you do, you get a 6% appreciation. You get cash flow, right? Let's say $2,000 a month. That's $24,000. I'm at $36,000 a year to buy that $200,000 house. I put $40,000 down. That's 20%. I got $36,000 in return, which is almost 100%. And I hadn't even got to some of the other write-offs that I get. So the point, somebody else's money. And I'm using somebody else's money. So when you're looking at that, you can almost get, and in some cases you can get more than 100% cash on cash return. Cash on cash is the return you're getting on the amount you put down. Okay, that's what we mean by cash on cash. So if you put $200,000 down as opposed to 40 because you bought the house with cash, your return is going to come down more to that 10 to 15% annualized. So anyway, I hope that helps.
That's awesome. Thank you. Just continuing here on the real estate track, we've got a question from chat, and they are looking at getting into real estate with investments, and they're wondering what's the best thing to purchase right now, short-term rentals, long-term rentals, or flips?
Well, I'll let one of you guys handle that.
Go ahead, Dan.
Well, I think it depends on your financial situation, whether it's a buy and hold and rent or a flip. If you're cash starved, you might want to do a flip. But if you're looking at just maybe replacing your working income and you've got a bunch of lazy money, which is money not working for you, I would buy and hold that rental and keep it for long term. So it really depends on your financial situation and where you're at in life right now. I flip a lot of houses. I buy and hold a lot of houses. And the reason why I flip a lot of houses, A, is because none of us have an unlimited amount of income or money. And so I might flip 2 houses so I can continue to buy some really good rentals that are going to appreciate in value over time. So with my rentals, I'm projecting what they're going to be worth and what they're renting for. But my flips are usually, I call that a steak, a steak versus a milk cow. My rentals are milk cow, and my steak is I want to continue to keep my cash flow to the degree that I can buy those hot properties when they come up. So for me, it just depends on where you're at financially.
Mm-hmm. Good answer.
Good answer, Dan.
Yeah. And I'll finish up here with one last question. I can't believe our time is up already. It's gone so fast. But this is from Bill, who lives in Santa Barbara. His question is, how long do you think these low interest rates will last? Will they last until late fall?
Yes. That one is fairly easy. I think that's a good question, by the way, Bill, and I appreciate the question. What happens is, so everybody knows who's watching, we've been in a low interest rate environment now for quite some time. And what's always the issue is can you get the economy growing and still raise rates? Honestly, the healthiest economy we can have is when, let's say, a normal mortgage rate would be somewhere in the 6% interest. Now, don't cringe on me or throw any rotten tomatoes at me. I'm talking about getting to a balanced economy. But what's happened in the last 15 years, we've been in this low rate environment. Becky and I, when we bought our first home, we were thrilled to get a 9% interest rate. In fact, we thought that's like today getting 2.75. Yeah. Back then we got 9%.
Because they were in double digits.
And some of you want to know when was back then? Well, I'm only 39, so it couldn't have been that far ago, but I think that was 1982. No, it was 80. The cream house was 83. So I think it was 1983, and we got 9%. We thought we hit the jackpot.
We did.
And interest rates, remember, interest rates peaked in 1980. Okay, so 81, that the prime rate went up to 17%. And then ever since it's been coming down, and we went right through 83, 84, and we did that I think it was 84, 83. We got 9%. So you say, well, how come you're telling me all that? Well, because we've been in these low interest rates for a long time. And right now, based on what we're showing you on the economy, what we're saying, I don't see low interest rates going anywhere. Now, let me tell you what quickly, because I know we're over time here, but the flip side of that is the cheaper the money is, in other words, the lower the interest rate is, what happens, it will drive asset prices up. What makes real estate, though, I think safer right now is that there's no way in the economy that the Fed or the government is going to be able to raise interest rates like, 1% or 2%. We call that 100 basis points, 1%. Right now, if the Fed came in and raised it 0.25%, it would drive the economy more negative than it is now. So we're going to be in a low rate interest environment for a considerable period of time, and there's going to have to be a real turn in the economy to see that change.
Great, thank you. Also want to remind everybody that Billy's going to be back Wednesday at 1 p.m. Mountain to answer more of the questions. We have several questions that didn't get answered, and I know you cover as many as you can on Wednesday. So Billy and Becky, I'll turn it back to you to close us today.
Thank you, Karen. And I just want to thank Karen and our panelists, and I also want to thank our office staff team that's kind of behind the scenes, and Gabriella and Celine and Miriam that are helping us as well and helping us with chat. Thank you guys. And Derek Packard helps us behind the scenes. So we appreciate that.
We need a lot of help.
Yeah, we need a lot of help, believe me. So we're actually in our home today in Denver in Lone Tree. And so I'm actually, I said in the beginning when we first came on, I'm actually smoking a brisket in the backyard
It smells so good.
on a real Texas pit with a big firebox on one side and a big pit on the other. And so anyway, I'm smoking it, not smoking it like smoking, but, you know, smoking the meat. But today, before we go off, we want to pray.
Amen.
And we want to pray for those that are watching and that are participating with us.
Amen. And I do want to give a shout out. Today's my daughter's birthday. Happy birthday, Brooke.
And our daughter's birthday, Brooke, she's in Hawaii. So let's pray together. Father, right now, we just thank you for your blessing and your grace on people that are watching. We pray today over their health, their physical health, and we speak health and healing. But today as well, we pray over their finances. We pray for wisdom, understanding, and knowledge to come to them in the area of their finances. We speak blessing and increase over them today in Jesus' name. Amen.
Amen.
Well, God bless you. Thank you for joining us. We'll see you Wednesday at 1 p.m., next Saturday at 10 a.m. Both of those times are Mountain Standard Time. So we'll see you then. Bye-bye.
Bye-bye.